Discover the tips and strategies that will help you achieve your retirement goals. I'm your host, James Knoll, and this is the podcast dedicated to helping you retire well. It all starts right here on Ready for Retirement. Hi, everyone, and welcome back to another episode of Ready for Retirement. I'm your host, James Knoll. And on today's episode, we're going to compare and contrast the effectiveness of two different tax strategies, particularly how do you understand which might be best for you in different situations. So this is based upon a question from a listener. This listener's name is Casey. Casey, thank you for submitting the question. Casey says, "Hi James, your show is outstanding and I look forward to listening every week. I was wondering if you could discuss and compare the relative benefits of Roth conversions versus tax gain harvesting, particularly during early retirement when someone's marginal tax bracket is low. I know both can be beneficial, but how does a person determine which is more so? Thanks very much." Casey, thank you very much for that question, and thank you for that kind feedback. It's very helpful. So essentially what Casey's asking is, as you retire, when you retire, in many cases, you have a lower taxable income, or your marginal tax bracket is lower than it likely was in your working years. So when it's at that point, how do you understand when different tax strategies might be best? And that's what we're going to talk about on today's episode. Now, before we do, quickly wanted to highlight a review of the week. This review comes from username HCBMW. And user HCBMW says, 5-star review, best I've run across so far. James does an excellent job in providing insight into all aspects of financial planning for retirement. Thank you very much for that. Always appreciate that feedback. If you have not left a review and have been meaning to do so, I would invite you to do so right now. It really means a lot, allows more and more people to find the show, and it is fun to see the number of people continue to grow really exponentially every single month. So thank you for that review. Thank you to all of you who have left reviews. It really helps me, it helps the show, and it helps more people who are also looking for information like this. Also, if you have not done so already, just a quick plug for the YouTube channel, be sure to check it out. It is under Root Financial Partners. That's my company name, and that's the YouTube channel, the name that it's under. If you're listening right now and you're on, say, Apple Podcasts, if you just click into the episode, and if you scroll to the bottom, there's a little thing that says, we're on YouTube, and there's just a URL or a hyperlink that will take you straight to that YouTube channel. So, quick commercial for the YouTube page and for leaving a review, and let's now go back to the question for today. So back to Casey's question, he was asking, when do you know if you should implement a tax gain harvesting strategy versus when should you know if you should implement a Roth conversion strategy? Now, for those of you listening, just want to quickly start by laying out the foundation of what is tax gain harvesting. Well, to start, tax gain harvesting is not the same as tax loss harvesting. In many ways, they're the opposite, but it has to do with the same type of understanding of how taxes work for capital assets and capital gains as opposed to ordinary income. So when you tax loss harvest, which is probably what most people are familiar with, what you're doing is you're selling a security at a loss, you are booking that loss, in other words, you're able to write off that loss, and then you're buying a similar but not exact same investment. So when you're tax loss harvesting, say I have an index fund that owns big US stocks. Well, maybe that index fund has gone down in value because the market has dropped in value. Well, if I sell that, I can't buy the same exact fund. Otherwise, I violate what's called a wash sale rule. I can't even buy a fund that's substantially identical. I have to buy something that's similar but not exactly the same. So maybe it's another index fund that has a similar benchmark that it's trying to track, but a little bit different. So I can buy it. So I'm still participating in the market if the market recovers right after that, but I've been able to book that loss and write it off against either any capital gains that I have, or I can write off up to $3,000 of that per year against any ordinary income that I have. So that's tax loss harvesting. That's what most people are familiar with. What tax gain harvesting is it's the opposite. With tax gain harvesting, you are intentionally selling a security at a gain. And for most people, when they hear this the first time, they say, why on earth would I do that? Why would I try to pay taxes when I'm selling something at a gain? Well, you're doing it because you might potentially not be paying any taxes on it. So tax gain harvesting, it can potentially be tax-free. So selling these investments at long-term capital gains if the following provisions are met. Number one, it must be a long-term capital gain or a qualified dividend. Those are both taxed the same. Now, with qualified dividends, you have no control over when those are really received. But with capital gains, you do have control over when those are realized. And number two, if your taxable income is under certain thresholds, then you might qualify for capital gains rate of 0. So for 2022, if you are filing your taxes married filing jointly, the long-term capital gains rate is 0% if your taxable income is below $83,350. If you're single, then it's just half of that, $41,675. But for the example, let's look at that married filing jointly tax bracket. So $83,350. If your taxable income is lower than that and you realize a long-term capital gain, again, it cannot be a short-term capital gain because short-term capital gains are taxed at ordinary income rates, which is why ideally we want to avoid those as much as possible. But if it's a long-term capital gain, so it's been held for a year or more, then you can realize this at 0% if your taxable income is below that threshold. So for example, if you're listening to this and your taxable income is, say, $50,000, let's assume that you sell an investment that realizes a capital gain of $10,000 if it's a long-term capital gain. Well, when you do that, you're not actually going to pay any federal taxes on that capital gain. You might pay state taxes. So I'm in California, for example. California doesn't distinguish between capital gains versus ordinary income. It's all just taxed at the same rate. But every state's going to be a little bit different. So you may potentially have state taxes on this, but at the federal level, you won't. And in this case, I'd actually say if your taxable income is $50,000, and if you do realize a capital gain of $10,000, and there's not going to be any other income that year, I would probably encourage this person, this hypothetical make-believe person, to realize more capital gains. Because until they hit that threshold, which again is $83,350 of taxable income, they're not going to pay any federal taxes. So let's look at an example for this person. Let's assume this person who has taxable income of $50,000 bought Apple stock. And they bought Apple stock a long time ago. And maybe they bought it for $500 and now it's worth $10,000. Well, they've been holding on to it because they didn't want to realize any capital gains. But now what they can do is if their income is at that level, if they were to sell that $10,000 of Apple stock, the $9,500 of gains there is actually not taxed because they're under that threshold. Here's the interesting thing too. I mentioned that with tax loss harvesting, if you sell a security, you cannot immediately rebuy it for at least 30 days, otherwise you violate what's called the wash sale rule. With capital gain harvesting, there is no such rule. So hypothetically, this person could sell Apple, turn right back around and buy those same exact $10,000 worth of shares. And what they've done is they've stepped up their cost basis without actually changing their investment mix. So when I say they've stepped up their cost basis, instead of the cost basis being $500 now, which is what they originally bought it for, they sold and rebought, and the new cost basis is $10,000. So in the future when they sell, the taxes will only be on the difference between whatever they sell for at that time and $10,000 as opposed to whatever they sell for in the future and $500. So a wash sale, again, just to make sure I'm very clear with this, a wash sale, it occurs with tax loss harvesting when you sell a security at a loss and then you purchase the same or substantially identical security 30 days before or after the sale date. So in either direction, 30 days before or after, if you buy the substantially identical or identical security, that wash sale goes into play, which means you can't actually book that loss. With tax gain harvesting, you do not need to worry about this. With tax gain harvesting, you could sell a security, immediately turn around and rebuy it, and you've just stepped up your cost basis. And if you're under that threshold, you don't pay any taxes at the federal level to do so. So tax gain harvesting can be a really, really incredible tool for a lot of people. And let's just explore it one step further here. So when you're looking at tax gain harvesting, what you're focused on is your taxable income. Your taxable income is essentially your adjusted gross income. So add up any money or any income that you have from salary or pension or IRA distributions or whatever it is. Add all that up, and that's your adjusted gross income. Then you subtract your deductions from that. So whether you take a standard deduction or you itemize your deductions, once you start with your adjusted gross income as the high-level number, you back out your standard deduction from that or your itemized deduction from that, and that gives you your taxable income. So here's the real limit that you want to keep in mind. If your adjusted gross income for 2022 is $109,250, if you're married filing jointly, if you start there and then you take a standard deduction, which for this year is $25,900 if you're under 65 and you're married filing jointly. If you're single, it's lower. If you're over 65, your standard deduction is actually a little bit higher, so that helps you more. But if you take your standard deduction from that, you get a taxable income of $83,350. So what we just did there is we worked backwards to say, okay, if we need our taxable income of $83,350, if that's the threshold, so if our income is lower than that, we can implement tax gain harvesting. If our income is higher than that, we can't. We can still realize gains, but we're going to pay some taxes for that. So if we start with a taxable income of $83,350, add on the standard deduction of $25,900, that gets us to an adjusted gross income of $109,250. So that's kind of the high level number I'd like to look for with people to see, is your adjusted gross income below or above that number? If your adjusted gross income is below $109,250, then you can realize some long-term capital gains at no federal taxes. So I do want to be very clear, this does not mean you can realize all of your long-term capital gains at no federal income taxes. Essentially what you can do is realize the amount between what your taxable income is and that limit of $83,350. So sorry, I know this episode's kind of dense with numbers here, but I want to make sure that we're grasping when this does and when this doesn't work. And some of these numbers aren't perfectly round numbers, unfortunately. It's just the standard deduction or the limits that have just been implemented as part of the IRS tax tables. Let's look at an example using round numbers to see how this might play out. Because again, I do want to make sure some people think, oh my gosh, my income is below this. I'm going to go sell all my stocks or all my investments at a gain because I'm not paying any taxes. Not necessarily. Let's look at an example to illustrate how this works. Assume your adjusted gross income is $90,000. Let's then assume that you back out $30,000 for deductions. I know the standard deduction is lower than that, but I want to use a round number. So let's assume you itemize. Maybe you have some mortgage interest or some state and local taxes, maybe some charitable gifts, whatever it is. I'm going to assume that you itemize your deductions and your total deduction for this year is $30,000. So if our adjusted gross income is $90,000, then we back out $30,000 for deductions, that leaves us with a taxable income of $60,000. So $60,000 is our taxable income, which is less than the threshold of $83,350. In fact, it's $23,350 less than that. So what that means is we could realize $23,350 of capital gains and pay 0% in taxes in doing so. If we realized more than that, then that $23,350 of gains is still tax-free, but any gains realized above that threshold would be taxed at 15%. One other thing here, again, I don't want to get super detailed and granular, but this is important information to know. When I say you realize $23,350 of gains, that doesn't mean you just sell $23,350 worth of stock. You could potentially be selling $500,000 worth of stock if the gain on that amount is that $23,350. So it's that gain that we're looking to realize, not necessarily the sale amount that we're looking to realize. Usually the actual sale will be a lot more, but part of that sale is our cost basis, which is just really what we purchased the stock for, which is not taxable to start with. It's just the gain that's taxable. So that's really the number that we're targeting here. But in other words, if you look at your taxable income, you can realize long-term capital gains between your taxable income up to that threshold of $83,350 and pay 0% federal income taxes on that. So that's kind of a long-winded structure. That's the benefit of tax gain harvesting as opposed to tax loss harvesting. What Casey's question is he's asking, and it sounds like Casey understands those benefits. He's saying, okay, should I do that or should I do Roth conversions? So when you first retire, a lot of people's taxable income is lower. They're not earning the same salary, and depending on where they're pulling money from, they have that tax window and their taxable income is lower. And so he's saying, what makes more sense? Should I do the tax gain harvesting or should I do Roth conversion? Well, some people might hear that and say, well, wait a minute, Casey, Roth conversions, anything that you do there, that's taxed at ordinary income rates. In capital gains, those are taxed at capital gains rates. So you should be able to do both, right? No. It's true that capital gains and ordinary income from Roth conversions are taxed on separate schedules, but the capital gain threshold that you pay taxes on is based upon your taxable income. What I mean by that is that $83,350, That's the amount of taxable income that you have to look at. And again, taxable income is simply your adjusted gross income minus any deductions. Well, your adjusted gross income includes both capital gains and ordinary income. So I know this is a little bit confusing, but even though capital gains rates are different than ordinary income rates, both capital gains and ordinary income drive up your adjusted gross income. So because they both drive up your adjusted gross income, it does impact what threshold or what brackets your capital gains will be taxed at. So let's go back to our example to see how that plays out. If we assume that some couple has $90,000 of adjusted gross income, if they back out $30,000 for deductions, they have $60,000 of taxable income. Well, we looked at before, they could do some tax gain harvesting to pay 0% federal taxes on any long-term capital gains. But let's assume they went a different route. Let's assume they want to do Roth conversions because they said, okay, with $60,000 of taxable income for 2022, that puts us in the 12% bracket. They then decide they're going to convert $23,550, which is what fills up the 12% ordinary income bracket. So this couple does this because they say, you know what, we want to fill up the 12% bracket to avoid higher brackets in the future from things like RMDs. Well, now their taxable income is up to $83,550, which now pushes them into the 15% capital gain bracket, which means if they were still to realize those long-term capital gains of $23,350, they'd now be paying 15% on those capital gains instead of 0%. So they'd have an additional about $3,500 of taxes they'd have to pay because those capital gains would now be taxable. So as you're looking at this, you have to determine which is better for me. Should I be realizing or should I be implementing a tax gain harvesting strategy where I'm intentionally realizing gains, but under certain thresholds so I don't pay any taxes on those gains? Or should I be implementing a Roth conversion strategy to prepare for the future? So maybe I'm not hit as hard for RMDs. Well, which is better? As with everything, it depends. It's going to depend on so many different factors and variables, but let's break down what some of those factors and variables might be. So here's some of the things, so it's not going to be comprehensive, but here's some of the things to consider. Number one, the first thing that I want to check out to see should you do Roth conversions or should you do tax gain harvesting is I want to know how impactful our RMD is going to be for you. So RMDs, required minimum distributions, the impact of those is largely going to be driven by how much money you have in your pre-tax balances. So 401ks, 403bs, 457s, traditional IRAs, the more you have in those types of accounts, the more you need to be worried about the impact of RMDs in the future. The less you have in those types of accounts, the less you need to be worried about RMDs in the future. And the reason for that is quite simple. It's that your RMD is going to essentially be a percentage of any pre-tax balances you have. So the percentage stays the same and it's just based upon your age, but the actual amount you'll be forced to take out is going to vary based upon your portfolio size. Because if I have to take out, say, 4% of a portfolio, 4% of a pre-tax account, well, that's going to look a lot different if I'm taking out 4% of, say, a $100,000 IRA versus if I'm forced to take out 4% of a $4 million IRA. So you want to understand what's going to be the impact of this. And in fact, a few episodes ago, episode number 98, very similar analysis, if you've listened to that. That episode was all about how do I prioritize health insurance subsidies versus Roth conversions. So same type of conversation. When income's lower, should I try to qualify for a health insurance subsidy or should I try to implement Roth conversions? Same type of conversation here. For both of them, you have to have a basic understanding of how RMDs will impact your taxes in the future. For example, if you're converting your Roth today, or if you're converting your IRA today into a Roth, and then say you're converting at 12% bracket, but maybe you're still going to be in only a 12% bracket or a 10% bracket by implementing Roth conversions, it's not maybe saving you a whole lot. And in fact, it might be break even, might not be a whole lot of purpose to doing so. Well, that doesn't do a ton of good. So maybe in that case, you do look at tax gain harvesting as something that might be better for you. Versus if you're converting at 12% today, and that's going to save you from having to pay at the 24% bracket or 32% bracket or whatever brackets even are at that point, well, that's where you might err towards saying, okay, the Roth conversions might make more sense, or might lean towards saying the Roth conversions make more sense. Unfortunately, it's not as simple as just saying tax gain harvesting saves 15%, James, because if I do it under the threshold, I pay 0% taxes, and if I do it over this threshold, I pay 15% taxes. So that's kind of the simple way of looking at it, and you compare that to Roth conversions of saying, well, if I convert today at 12%, and I save in the future at 24%, it's only 12% gain. Not necessarily, because a lot of those Roth conversions and the benefits of them, it's compounding over time versus if you do some tax gain harvesting, so it's kind of a one-time tax savings. There's not necessarily that compounding effect that happens. Plus, there's other couple of variables in there as well. So there's no simple formula for quantifying this exactly, but you have to start with that. Another thing that you want to consider is that capital gains rates are more attractive than ordinary income rates. So if given the option of having $1 taxed at ordinary income rates or $1 taxed at capital gains rates, capital gains is going to win every time, at least with tax brackets today. There's not a point on the tax bracket, just the tax rates, where for some given level of income, you'd be paying more in capital gains taxes than you would at ordinary income tax rates. So if given the option, I would prefer to be taxed at capital gains rates. So to me, this favors the decision of prioritizing Roth IRAs sometimes, or Roth conversions sometimes, because it's helping to minimize the impact of RMDs, which is going to be taxed at ordinary income rates, versus capital gains. Yes, we want to mitigate that as much as possible, but it's a lesser tax burden to have to face. So it's not as simple as saying, okay, I'm going to do everything that lowers the ordinary income rates as compared to lowering capital gains rates. What you want to do at the end of the day is compare dollars to dollars. Again, there's not a perfect formula. A lot of times it just takes more robust software to be able to analyze some of these things. But even with robust software, it's impossible to be precise because there are so many variables and so many variables that are going to change over time. But you can make a set of assumptions. And you can say, if this set of assumptions is reasonable, then what you get is you're going to get a general sense of what might be most impactful for you. And yes, nothing's going to be perfect, but it's better to be approximately right than exactly wrong, is an old saying. So how can we do some estimates? How can we run some projections to understand, is one going to be more impactful than the other, knowing that capital gains rates are more attractive than ordinary income rates. The third thing I'd like to consider is just flexibility. Unless tax laws change, you could tax gain harvest at any time, even past age 72. So whether you're doing that in your working years or early retirement years or later retirement years, there's no limits for that. That matters because when you're looking at things like Roth conversions, you're typically wanting to maximize the extent that you do Roth conversions before you turn 72, ideally. Not always, but in most cases. And the reason for that is you want to do Roth conversions before RMDs kick in, because once RMDs kick in, that's the point at which you don't really have a whole lot of control. Your income floor at that point is going to be maybe as high as it will ever be, because you'll have Social Security, you'll have your RMDs, you'll have any potential other income sources, and you just can't go lower than that. Whereas before that, you can be strategic about where you're pulling income from, doing Roth conversions. When you collect Social Security, you can manipulate your tax situation a lot better to prepare for the future. But after 72, you lose the ability to do that. Also keep in mind this, when we're talking about flexibility, any capital gains that you have that are retained and you don't ever realize them, they pass to heirs tax-free, at least as tax law stands today. So there's a step, we do tax gain harvesting because it steps up basis and it doesn't cost you any money to do so. So you're not paying any capital gains taxes and you're able to step up the cost basis. Well, if you were to pass and you were to pass money to children or to heirs, any of the capital gains that you have, there's a step up in cost basis for that too. So unlike IRAs or Roth IRAs, any amount that you pass to an heir that's in a traditional IRA, with the recent change to how RMDs are processed, there's no minimum distribution they have to take anymore, but they do have to fully distribute that account over 10 years. So there's a short period of time they have to distribute a big pre-tax account balance potentially, versus any assets that are in a brokerage account or trust account or just non-retirement account. Any gains that you have upon your passing, there's a step up in basis and those pass to heirs tax-free. So there's not as much rigidity in terms of having to get these capital gains realized. If you don't realize them, not necessarily a problem if they just pass to your heirs, versus with IRAs, if they're not converted, you're going to have to take them out and your heirs are going to have to take it out with a lot less flexibility. Now, I do want to make sure that I'm saying here, don't let your asset allocation get out of control by avoiding capital gains. I wouldn't recommend listening to this and saying, oh, great, I'm just never going to touch my stock investments because they'll pass to heirs tax-free. Well, number one, let's make sure we're planning for your retirement first and foremost before considering heirs, although that is a good consideration. But number two, if you just don't let any of your stocks, or if you don't ever sell any of your stocks and they keep growing tax-free, well, at some point you might get your portfolio way out of balance. So for example, let's assume the only stock you own in a brokerage account is Apple stock, like our example before. Well, at some point, if that just keeps growing and growing and growing and growing, that's just one US company, and it's not really diversified. Now, it's a wonderful US company. It's maybe the best stock, arguably, ever in terms of its market capitalization today and what it's done, but it's still just one company. Now, if you had, say, a basket of US stocks, say maybe the S&P 500 fund, just a S&P 500 index fund, for example. Well, if that's growing and growing and growing and growing, and you're saying, oh my gosh, how on earth do I get this in balance without triggering a huge tax consequence by selling? Well, keep in mind that concept of asset location. Can you offset, or can you rebalance inside of your Roth IRAs or your tax deferred or tax-free accounts to compensate for what's happening in your brokerage account? So if you're way out of balance and you're way too heavy US stocks, for example, in a brokerage account, but you don't want to sell because you don't want to incur those capital gains, well, do you maybe go extra heavy on international or emerging markets or some other asset class in your IRAs and Roth IRAs where you can rebalance in a completely tax-free way so that your overall portfolio looks like it should? So that's one consideration there. On the flexibility piece, if you don't ever have to sell your capital gains, if you don't want to or you don't have to realize them, just don't let that get out of control in terms of what your portfolio looks like. So those are some of the main considerations. There are other factors too, depending on your scenario. A lot of them are too detailed and specific to make a whole episode out of, but things like charitable giving, that comes into play here on both sides, because you can implement charitable giving with appreciated stock, and you could do charitable giving through a qualified charitable distribution to avoid RMDs from your IRA. This doesn't factor in things like a strategy for minimizing health insurance premiums or qualifying for a subsidy. This doesn't factor in things like, well, what's better to reduce IRMA surcharges? The more things we start to introduce here, the more complicated the decision gets. So I wanted to focus fairly high level on what I believe to be the biggest factors with this. So I hope that was helpful. Casey, thank you very much for this question. I think it was a good, healthy question for everyone to explore, just in understanding this concept of prioritization of the different options available to you. It's not like there's a perfect, cut and dry, black and white strategy that's best for everyone. It depends, and depends on a bunch of variables. So how do we work through the options and understand when might each option be best for you individually? So thank you everyone for listening. Be sure to check out the YouTube page under Root Financial Partners. Be sure to leave a review if you've not already done so. Thank you for listening, and I'll see you next time. Thank you for listening to another episode of the Ready for Retirement podcast. If you're enjoying the show, please subscribe and let me know by leaving a 5-star review. And as always, for a list of the notes and the resources mentioned in today's episode, you can find those at the Ready for Retirement website, which is readyforretirement.co. That's readyforretirement.co. And if you have a question that you would like for me to answer in a future episode, then you can also go to the Ready for Retirement website, readyforretirement.co. There's a page called Submit Your Question where you can submit a question for me to answer in a future episode. Thanks as always for listening, and I'll see you next time. Hey everyone, it's me again for the disclaimer. Please be smart about this. Before doing anything, please be sure to consult with your tax planner or financial planner. Nothing in this podcast should be construed as investment, tax, legal, or other financial advice.